Well, my name is Gemma Hedges. I'm a tax director at HWB, which is a chartered accountancy firm based in Chandlersford. We're a single office firm, there's about 70 staff in there, and we offer everything for businesses effectively, so personal tax, corporate tax, accounts, a bit of audit, a bit of payroll, and a bit of tax advice on properties. So we're also part of a global network called ETL, and that's been really useful for us because it's enabled us to advise our clients more effectively if we have offshore matters. And that's something that we couldn't do before that. And so it's a useful concept for us, and it, I feel, sets us aside from other accountancy practices maybe in the area. Apart from the bigger firms, that's where you'd be paying the bigger sums of money for fees. So it helps us offer a really valuable service to our clients. So what we're going to talk about today is property tax, and it's a dry subject, to be very honest. So rather than talk through this is how individuals are taxed, this is how companies are taxed, and these are all the different reliefs, I thought what I would do is talk about what clients tell me. And these are things which they say with absolute definition as a statement of fact. This is what the tax position is. This is what many of you that are lawyers or IFAs, things you may have heard before. It's usually my mate in the pub said, or my mate in the pub did. So what we're going to do today is we're going to learn about property tax through the eyes of our clients and their statements of fact. So let's start with the first one, and that is the sale of my house is tax-free. Now, if you sold your house and on the day of completion you move into a new property and then you start living in that new property as your home, absolutely, I agree completely with you. The sale of your house is tax-free. Brilliant. But the relief, so it's not an exception, it's a relief, requires you to have fully occupied that property as your main residence throughout the period of ownership. So to give an example, one such client had a rental property, and he himself lived in a property with his partner at the time. And he said, but I can claim main residence relief on this because I only own one property. And the question was, but did you actually live in it? And he went, oh no, I didn't, but it's tax-free because I only own one property. So we revert back to this. Did you occupy it as a main residence? No, you didn't. You never lived there. So no, that disposal is not capital gains tax-free. You also have a position if perhaps your sale of your property is proving a bit tricky and you've found your dream house and you want to move into it. So maybe you get a bridging loan so that you can move into your new property, and then it'll just take a little bit longer to sell your old one. Now, if that sale process takes more than 9 months, then you will not qualify for the full relief, because the relief of your main residence, the PPR relief as we call it, that gives an exemption for the last 9 months of ownership. So they treat that as deemed occupation, even if you never actually lived there. But if it takes 12 months to sell your house, you won't have a full period of main residence relief, and therefore you will have a chargeable gain over that 3-month period. Now, that 9 months is extended to 36 months to move into a care home, and that's a really useful exemption because sometimes you don't really know how long a person's going to live, and that just gives you that little bit of extra window of time. And there are some other periods of absence where they will be treated as deemed occupation, but with those other periods of time, you have to reoccupy the property after you've moved out, after you've been absent from it, if you want that period of absence to be deemed occupation. So, for example, your employer sends you to work in Australia for 2 years. You go there, you think Australia is amazing, why would you come back to the UK? So, I know, I'm going to sell my property that I've retained and that I was going to move back into when I came back to the UK. Now, if you do that from Australia, then you've actually only got that 9-month window of deemed occupation. You haven't got that 4-year period of absence. And if you want that 4-year period of absence, you have to come back to the UK first, live back in that property again before you sell it. So it's not so straightforward. It's not just the sale of my home is tax-free. And then you've got, what about if you have more than one property? My daughter has a friend who's very lucky. They have a house for summer and a house for winter. They occupy both as their main residence, but one has an outdoor swimming pool, and you obviously can't live in that one in the winter because it's not very warm. So if you've got more than one residence, how do you know which one's your main residence? Can you get main residence relief on both? So No, you can't get main residence relief on both, even if you occupy both as your main residence. You can elect which one you want to get main residence relief, but you have to make that election within 2 years. Now, that 2-year window isn't 2 years from when you bought these two residences, it's 2 years from a change in the number of properties you own. So if they then buy a rental property, they could then elect or change the election onto a different residence because they have at that point now got 3 properties rather than 2. And similarly, if they dispose of a rental property, they can then change that election because they've changed the number of properties that they own. So, that nice, easy, my house is tax-free, is not quite so straightforward after all. And then you get the real fun, because if it's not fully exempt, then you need to do 60-day CGT reporting. Now, this was 30 days, which was absolutely horrific, because the CGT reporting involves registering for a government gateway in the first instance. Now, if you have one of these, you know you have to send off everything, including the inside leg measurement, to get set up in the first place. And then clients have to go in and register a property account before we can then help them as agents. So just the process of setting up the government gateway generally takes more than 60 days, particularly if it's an elderly client. And then you have the to and fro, so the agent code is sent to them by post, obviously, because that takes about 20 days to come out to HMRC. And they need to enter that in the system before we can help them with the CGT reporting. So that 60 days is a tight deadline. It was 30, 60 days is welcome. But you're reporting that same gain on the 60-day CGT return as you later report on your self-assessment tax return. So we quite often get clients say, well, let's just not do this top bit. Why would we do that? Let's just go straight for the self-assessment tax return. But if you don't fill in that 60-day CGT reporting, you will be fined until you do. And once you've submitted the self-assessment tax return, it's now harder to go back and do the 60-day reporting because you now can't do it online. Now you have to do it by paper. If anyone is currently communicating with HMRC, I know that's rather a lengthy process by paper. And you may or may not have a response in a year, or they may or may not have lost your post. So 60-day CGT reporting is really important. It's regularly missed. And it's also for persons. Now, persons is important because it's not individuals. So persons means it's for estates and it's for trusts. So people that are going through probate quite often won't have set up a government gateway. They might not be doing tax returns anyway. They are completely oblivious to the 60-day CGT reporting, and we might find out 2 to 3 years later that they've missed all of this completely, probably because they thought it was a sale of a house, and so obviously it's completely tax-free. So that's your misconception 1. You'll be pleased to know the rest are a little bit quicker. So misconception number 2, it's more tax efficient to be married. Now, anyone who knows me knows I love a good wedding. I regularly advise my clients to get married. And that's not just because I love a good wedding, it's because I do a lot of inheritance tax planning. And people will come to me that have been in long-term relationships and say, I'm a modern day person, I don't need to get married. And I say, well, that's fine. But when you leave all of your estate to your spouse, to your partner, sorry, then it's going to suffer 40% inheritance tax. And quite often they then find themselves at the registry office and they're not quite so modern after all, because now they've saved themselves 40% inheritance tax because their estates qualify for the spouse exemption, which is great. Also, you can do lifetime gifts. So we can transfer property into a spouse's name. Capital gains tax free. You can't do that if you're long-term partners. There is no such thing as a common law spouse. I feel like all the lawyers want to cheer at that point. But if you do that, then you can split the income between you, and you can make use of one spouse's personal allowance or basic rate band that wasn't previously being used. So from a planning perspective, I love a good wedding. But from a main residence relief perspective, it's not a good idea to get married, because you can only get one main residence relief between one property that is elected as your main residence. Now, I have a friend that's using this as a reason to not marry his long-term partner. I wouldn't necessarily recommend it. I don't know how much longer she might be his long-term partner. And I'm given to understand there are reasons other than tax why you may want to get married. So, misconception number 3. Transfers between spouses are tax-free. So we've already looked at the IHT spouse exemption. We've looked at the CGT, spouse exemption. So actually this one's right, isn't it? That all makes sense. This must be right. There's one we missed though, because there's no spouse exemption for stamp duty land tax. That one is not spouse exempt. So if my friend did decide to marry his long-term partner, they've got a main residence each, and he's got a rental property as well. If he gifted half of this rental property to his new spouse as a wedding present, then that would be lovely. What a lovely present. But there's a mortgage on that property. And so his new spouse is going to be named on the mortgage as well as at the land registry as the legal owner of this property. And actually now there is deemed consideration for stamp duty land tax purposes because she's taken on part of that mortgage liability. And you may say, well, yeah, but it doesn't matter because there's a 0% ban for stamp duty land tax, so she's not going to pay stamp duty land tax anyway. But she is though, because she's already got a property, she's already got that main residence. So actually she's subject to that 3% surcharge. So what he's actually given her, very romantically, is a stamp duty land tax liability, which is less appreciated than the property itself. So while on this subject, I just want to talk about how we make the transfer to a spouse. Now previously, we liked a deed of trust because it's nice and easy. The land registry would say it's Mr's property, and we'd have a deed of trust underneath that said, yeah, but it's not really, it's Mr and Mrs, he just holds it legally. But since the introduction of the Trust Registration Service, or the TRS, now we have to register that trust with the TRS. And we'd also have to go in every year and say, yes, all the details are still correct. So the ongoing compliance of completing a trust deed is more onerous than if you just did the land registry update in the first place. So previously, we preferred a deed of trust. Now I'd probably say we for a land registry update. Check in with Anthony that he agrees with me on this. But now we're talking about 50-50 ownership. And that's the automatic assumption. If you have shared ownership between you, then it must be 50-50. But what if my IHT report that had some income tax planning on it said, actually, you should hold it 80-20? You can't show that in the land registry. You could show it in the deed of trust, but you can't show it in the land registry. So you need to do a Form 17. And that tells HMRC that it's not 50-50, it's actually 80-20, and please can we tax the income on that basis. Misconception number 4. There are no tax consequences when you transfer property on divorce. So until you are divorced, technically still spouses, I think we would all agree with that. And so theoretically, the spouse exemption should apply, and that should be fine. And this one is a really horrible one, actually, because that is not the case. So you only actually get that spouse exemption, or until this year you only got that spouse exemption, in the tax year in which you separate. So in an ideal world, you would separate on the 6th of April, because then you have the whole year in which to decide who's getting what and transfer the assets accordingly. But in an actual world, it seems more common that you might get, or permanently separate, between Christmas and New Year. It seems like the Christmas celebrations cause a bit of a rift, perhaps somebody burnt the turkey, but either way, people's New Year's resolutions are to be single. And therefore you now have January, February, March, 3 months, 5 days, in which to decide what's going to transfer and actually make those transfers. And if you don't, then you are transferring at a deemed market value proceeds. So now you've got divorced, which is a bit rubbish, and you've paid capital gains tax, which is even more rubbish because you weren't thinking about tax when you got divorced, funnily enough. You had other things on your mind. So from the 6th of April 2023, they have extended that spouse exemption. So now it's 3 years after the tax year of separation, unless it's under a court order or a formal agreement, in which case there's no time limit. So these are really welcome provisions because the other ones were extremely harsh and were hurting people that are already probably hurting from the whole divorce process. And if we look at this from a main residence relief perspective as well, if one spouse moved out of the property and then the property was sold afterwards, if that period of time when they didn't live in that property was more than 9 months, then they don't get full main residence relief on the sale of the property later on. The spouse that did stay in the property does. That seems hugely unfair. So one person's got the house and they've got the tax-free gain. So what these changes did is they also extended the main residence relief provisions so that when that former home is sold, both spouses get the benefit of the main residence relief. So I am simplifying these rules hugely in the essence of time, because like joining up and talk for days on this particular subject, but I feel people may get a little bit tired after half an hour. So misconception number 5, and this is a really big one for me, and this is the one I'm asked almost on a weekly basis. Well, I say asked, I'm told on a weekly basis that it is more tax efficient to hold property in a company. My mate Fred said that it's more tax efficient to hold property in a company. And that's a big question. That's not a straightforward one-size-fits-all answer. There are lots of different things you need to consider. So let's look at what would happen if you owned it personally. You have tax on full profits made in the year, and they are at the tax rates of 20%, 40%, and 45%. And those are the rates you would find on HMRC's website. The rate you wouldn't find on HMRC's website is the 60% rate, which is the effective rate when your total income goes over 100,000 and you start to lose your personal allowance. So 20, 40, 45 and 60. And when you're looking at whether you've lost your personal allowance, you don't take a deduction for the interest you've paid, the mortgage interest you've paid in the year. So you can find you're actually paying tax on profits you haven't actually made. And you do get interest relief, but instead of being at the top of the tax calculations, it's right down the bottom, and it's only at 20%. So if you're a 45% taxpayer or a 60% taxpayer, you're massively losing out here. So you can see why maybe personal ownership may be not ideal. So let's look at company ownership. Well, you're still paying tax on the full profits made, but you're now at corporation tax rates, and they could be at 19% for small companies, 25% for large companies, or somewhere in the middle. Well, that's great, that's lower than 60%, but that's just in the company, you still got to get it out of the company. So now you're thinking, well, do I take salary? Do I take dividends? Salary, we're back to 20%, 40%, 45%. Dividends, we're at 8.75, 33.75, and 39.35. So you've still got those big rates of tax, and you've also got national insurance contributions if you're paying salary. Got to think about maybe the dividend allowance if you're paying dividends. You also got to bear in mind that there's a corporation tax deduction for salary and national insurance, but not for dividends. So I don't know, now is the company more attractive? Is it less attractive? It's not clear. So let's look at maybe an example. So you own a UK residential rental property. It's a good one because you're getting rent of £126,000 a year. Now mortgage rates have gone up. So your mortgage is now £100,000 a year, but only 20,000 of that is interest. The rest of it's capital repayment. So your cash in hand is 26,000. 126 minus 100. Hopefully we're all good with the maths there. If that property is in a company, then that profit is subject to corporation tax. So if you're paying at 90%, that's not too bad, you still made a profit. But if you're paying at 25%, the tax on that profit, which is 106,000, because you can't deduct the capital repayments, £26,500. So actually, cash in hand, you've made a loss of £500. So, well, the company option doesn't look too good anymore. Let's have a look at what it is personally. Well, that all depends on what your other income is. So, if we look at it as though you've got no other income, we'll keep things really simple. You've got no other income, no other expenses other than this mortgage interest. So your total income for personal allowance purposes is £126,000. You've lost your personal allowance because you've gone over your threshold. So that rent will be taxed at 20%, the basic rate, 40% in the higher rate, and 60% between 100,000 and 125, 140 over years. You do get interest relief, but it's only at 20%. And what this actually means is you're paying £43,888 of income tax on that rent. So now you've made an annual loss of £17,888 in terms of what cash you have in your hand. So hopefully this will demonstrate why people are wanting to incorporate their property portfolio. And perhaps the slide before will demonstrate why people are actually going, do you know what, I'm selling this is not worth it. Mortgage rates have gone up too much. But let's just look at it broadly. why would you put your property into a company? Well, you don't get the mortgage interest restriction. So if mortgage is key to you, you need that funding, then maybe the company might be better. From an inheritance tax perspective, I like a company because I can do planning, I can do income planning, I can do inheritance tax planning. So it's great for that. It's great for flexibility. It can be good for protection as well. So you can give your kids shares, but you can put no voting rights on those shares, so you can have a bit of protection like you would do sort of with a trust. And then we go into the more hazy area. So lower tax rate on profits. So if you look at, you pay 45% personally, 25% the company, yeah, absolutely, lower rate of profits. But it's a potential, because it depends if you want those profits out of the company. And then there's the lower tax rate on gains. So gains on the sale of a property are subject to corporation tax. That's at a maximum of 25%. If you've got a residential property, then you're paying 28% personally. So 28, 25, yeah, company's better. And you don't have that CGT reporting, which is a real burden. So, okay, companies starting to do pretty good now. But CGT reporting is one thing. Running a company every year and the admin burden of that is quite another. And that might be far worse. If you've only got one property, you might save maybe £100 a year if you did run the numbers. But you've paid £500 in professional fees to get someone to do your accounts, to do your company secretarial. So you're not really quids in here, you're actually losing. You have to pay one tax charge on profits. So if you need all the profits from the company, that double tax charge actually makes the company less tax efficient. And as an individual, you can get main residence relief if you live in that property. Do not hold a main residence in a company, that's got all sorts of issues, which I could spend a whole day on. And the tax rates can be lower, but hold on, we've just seen that on the previous slide, tax rates are lower in a company, but if your gain is on a commercial property, then your maximum rate is 20%. But in a company it's 25%, so actually now it's lower holding it personally, and you've got an annual exemption, although as Ed alluded to, that's getting less and less useful and £3,000 doesn't go very far anymore. So maybe personal is better than corporate, or maybe corporate's better, or it's just not really clear. So the answer to this one is, it depends. This is a tax advisor's favourite expression, it depends. And it really does in this instance. It depends on a lot of different factors. It depends on tax rates of the people who will receive the income. It depends if you want to do inheritance tax planning, do you need a mortgage? One of the big ones also is mortgage availability. It can be more difficult to get a mortgage in a company. And therefore, if it is, you may find you're paying higher rates of interest, which undo all of your tax savings that you've made by putting it in a company. So we're going around in circles. Company or personal ownership, really complicated. Run the numbers, best guidance there. But let's say that you decided actually the company is the way forward. We're definitely going to go the company route. So how do we get the properties into the company? Well, if you don't own the properties already, that's nice and easy. We just put the cash into the company, it's a loan. When the company makes profits, then we extract that, that's tax-free, great. But if you already own the properties, but you decided to incorporate because of the mortgage interest, then it starts to get more complex. So you might be able to claim incorporation relief if you transfer the whole of your business into the company. And that means the gains are rolled into the value of the shares. If you're not transferring the whole business, you might be able to get business asset gift relief. And again, the gains rolling into the shares. But you've still got stamp duty land tax. It's there niggling in the background because there is no stamp duty land tax exemption if you're an individual transferring your properties into a company. Although there might be if you're a partnership. So stamp duty land tax has its own rules. They don't make any sense to most people. It's probably just worth bearing that in mind. If you have a stamp duty land tax question, ask an expert, don't guess. So capital gains tax free, but you're still going to have a stamp duty land tax charge. So either way, you're paying something to get your property into a company. Or you could do a sale to a company, in which case people are probably thinking, but that doesn't make any sense because now I'm going to have to pay capital gains tax. And I haven't got any proceeds because the proceeds are in the company and they're going to be paid out of future rental income. And well, yeah, that's absolutely true. But if you sold your residential property to the company, you paid 28% capital gains tax, and then when the company makes profits, you're extracting them tax-free, then what you've saved is tax on salary, potentially 45, or tax on dividends at 39.35. So 28, 45, you've actually made a tax saving here. So HMRC hates the conversion of income into capital, it goes without saying, because of the difference in tax rates. But in this instance, you aren't paying the capital gains tax up front. So if you're confident that that company is going to make some profits further down the line, you may take that gamble on the basis of much lower tax rates by paying it as capital gain up front rather than income tax further down the line. So it's not something to overlook, but stamp duty land tax always in the background as like a niggling thing. Misconception number 6. So we're still on the company, I'm afraid. This is the last few slides on this. Dividends are more tax efficient than salary. Now, this question, it just moves constantly with personal allowance, with changes in corporation tax rates. And if you look at it broadly on the face of it, dividend rates lower than salary rates. Brilliant. National insurance on salary, not on dividends. Yep, definitely. Dividends must be the more tax efficient option. But they're not corporation tax deductible. So if you are the company, then you need to look at the full picture on the profits and think about the corporation tax rates and your personal tax that you're paying combined, and then work out whether it's more tax efficient. So if you're paying tax at the highest rates, the dividend rates and salary rates are closer. So the corporation tax deduction makes enough difference that you may actually find it's better to pay salary in those rates. But if you pay income tax at the basic rate, when there's a bigger distinction between salary and dividends, because you're looking at 20% or 8.75, then actually dividends might be not tax efficient. So again, we're back to no one size fits all. But there are some other points you should always take into account other than just tax. So I love a bit of tax, obviously, but when you're thinking dividends or salary, you should be aware about earned income. And this is something that Ed touched on earlier. You can't use dividends as earned income for pension contribution purposes. You will not get that tax relief on those pension contributions. And similarly, I had a case previously where clients stopped taking salary from their company and they instead paid dividends to the two of them and their 2 kids. It was brilliant, it had really good income tax savings. And then they went to remortgage their house. And the mortgage company didn't like dividends instead of salary, and they equally wouldn't take into account the fact that the kids had dividends as the family income, because the kids are not named on the mortgage. And therefore, they couldn't remortgage their house because they were taking dividends instead of salary. We also have seen this with the COVID grants, they all needed salary rather than dividends. There are always more reasons than just tax why you should consider whether dividends or salary are best for your clients or for you. So what's the conclusion on this? It depends. We love this expression. So misconception number 7. I'm going to start going into the overseas elements here. I own a UK property, but I don't live in the UK, so therefore it's exempt from UK tax. This one sort of keeps me awake at night or cowering in a corner shaking. In brief, that's very wrong on a number of aspects. But once upon a time, it was possible that you didn't have to pay UK tax on UK property owned by a non-resident company. But that was once upon a time, a long, long time ago. And the position now is so complex that actually you're probably better off just owning the property directly rather than through a company, because this whole mess here is where the government have tried to catch up with the CGT for non-UK residents. So previously you weren't charged capital gains tax if you weren't UK resident. Now you are, but they're not quite sure how to do it, so they brought in the ATED, which is the annual tax on envelope dwellings. So you imagine the dwelling is enveloped in a company. That's brought in 2013, and it started with just properties of 2 million or more, the big properties. And then it went down to 1 million. And then it went down to 500,000, at which point everyone I know that had properties in the company started panicking, because that's an annual tax charge. It is exactly what it says on the tin. And they brought in a CGT rule to go alongside that. And then they went, no, actually, this isn't working. Let's change our mind. Let's do, instead, CGT for direct and indirect disposals of UK land. And this is still land in a company, but now it has to have more than 75% of its value from UK land. So, in short, it's complex. where it's been brought in over time. They have rebasing, but it's different date for residential property to commercial property. Right old mess is probably the long and short of it. But if you look at it from inheritance tax, it's where the property is situated. So unless your home is a caravan, it's not going with you when you go abroad. So it is exposed to UK inheritance tax. And similarly, UK income tax. If you're renting a property in the UK, it's subject to UK income tax. Now, there might be a double tax treaty with the country in which you're a resident, which gives you some relief for the taxes between the two countries. But the general rule is it is still subject to UK tax. So no, it is not exempt from UK tax just because you don't live in the UK. Misconception number 8. And this is the complete reverse. I have a holiday home that I let. The profits are taxed overseas, so of course I don't need to put them on my tax return. And this unfortunately was an example of one of my favourite clients, and she was very conscientious. She does her tax return in June every year. She always completed a tax return in Switzerland for her Swiss rental property. But she didn't tell me she had a Swiss rental property because she didn't think she needed to, because she's completing a tax return in Switzerland. So she had an inquiry, and the long and short of this is that if you are a UK domiciled individual, you are subject to UK tax on your worldwide income. And you may get relief through a double tax treaty, but you still need to put that income on your tax return. You can't just ignore it. And it's also worth being aware that if you do have clients with offshore matters, that the inquiry window for offshore is wider. There was a little bit of an amnesty a little while ago where HMRC said, come forward now and we'll alleviate any penalties to be charged on you if you tell us all about your offshore right now. That's gone. Now they have a 12-year inquiry window to check into a tax return, which is much longer than the standards of 4 to 6 for careless and negligent. And the penalties for non-compliance are also higher than the standard, so it's a really horrible one to fall foul of. For me personally, it catches my clients that are really not intending to do anything wrong. They genuinely thought they were dealing with things in the right way and were complying with the tax obligations of both relevant countries. So it's not a nice one, that one. And last but not least, you'll be pleased to hear, my conveyancing lawyer will advise me on the stamp duty land tax charge on acquisition, because it just depends on whether the property is residential or commercial. So this is not designed to be disrespectful in any way to conveyancing lawyers, but the clue really is in the name. Stamp duty land tax. Lawyers will advise on the law, tax advisors will advise on the tax. So yes, they can fill in your stamp duty land tax form, absolutely, but they'd like it to be a nice normal transaction, just a normal, go right back to the first slides. You sold your home, you bought another one, nice and easy. It's residential before and after. Now, if we look at just the concept of residential, that means, is it capable of occupation as a dwelling? If you've bought a property in a residential estate, then obviously it's capable of occupation as a dwelling. It's lovely, it's got a nice chandelier in the dining room. But what if you bought a new build and it doesn't have a kitchen and bathroom in yet? It's just the walls and the pipes ready for them to be put in, but they're not in. So can you occupy it as a dwelling? And what if it's an old property and it's got a kitchen and bathroom in, but it's also got a hole in the roof and there's water pouring in? Is it capable of occupation as a dwelling? Is it residential? So actually there's a lot of case law in that area, because that is as clear as mud. So that dictates the rates that apply when you buy the property. So that's complex before you've even started. If your property is more than 500,000 and you bought it in a company, then actually you've got a 15% stamp duty land tax charge. That's a horrible rate, nobody wants that one. Don't have that surprise. You've got to think about the person who's buying it. Do they have any other properties? Is the 3% surcharge applicable? Is it going into a company? Is the 3% surcharge applicable? And then you've got these two other ones, the multiple dwellings relief and the linked transactions. So if you go on HMRC website, you will see all the different rates, residential, non-residential. But you have to dig a bit deeper to find those two. And so these are quite often overlooked. So if you own two properties next to each other that you've rented for years, and someone approaches you to buy them, and they want to buy both because they want to knock it through and make a big house for themselves. So you are selling two properties, same seller, so one buyer. That's a linked transaction. So that means that your two properties worth 250,000 each are not subject to stamp duty land tax for your buyer at 250,000 each. They're combined and they're subject to stamp duty land tax at 500,000 based on those rates We're now in the higher percentages. We've increased our stamp duty land tax charge. So bad. There are ways around these rules, but we're talking about them very broadly just for the purposes of today. The other one, which works in a completely opposite way, is multiple dwellings relief. So when I bought my home, it had an annex in the end of the garden, which I could rent on Airbnb if I wanted to, but generally the family just use it to descend at Christmas. Now, if I thought about that when I bought the property, if I consulted a stamp duty land tax expert, then I would find out that I could claim I'm buying 2 properties, not 1. And therefore, if I paid 500,000, I could split that into 2 lots of 250,000 and apply the stamp duty land tax rules on that basis, which would have saved me a lot of money had I known that. But I didn't ask the question. I just assumed that my conveyancing solicitor would know about this, even though they're a lawyer, they do the law, and I'm a tax advisor, I should know the tax. So the long and short of stamp duty land tax is ask the question. If it's not a straightforward transaction, ask the question. So, on the note of questions, does anybody have any on that quick rattle through of all of the tax?